I need some traction. You need some traction.
Hey everyone, Lloyd Lobo here, co-founder at Boast AI. We help innovative companies become successful by giving them access to government funding and resources they need to succeed. Today's Traction webinar is brought to you by Boast AI Launch Academy in partnership with Growth Blazers, Founder Institute, Lazarus Institute, and BCF Ventures. Great topic here today. And it's about the key themes in VC that are driving startup funding today. The market is absolutely bonkers, and couldn't find a better speaker than Zaz here, who's spent her career helping venture-backed startups build growth-generating relationships with enterprises and developing growth strategies. And today she's a principal in Next Coast Ventures, an early-stage venture capital firm based in Austin. And incidentally, I'm also in Austin, just working out of a hotel, which is a coincidence. And what I just realized, Zaz, is I have actually a driver's license appointment tomorrow. I didn't even plan for it. I completely forgot. And Zaz, you've got a great background here running BD and corp dev at Drop-Off previously, experience in BD and corp dev and M&A. You were previously director at Austin Ventures, Texas's largest and most active venture fund. So overall, you know the space really well, better than most of us, and we're super excited. Thanks for joining us. How are you?
Thank you for having me. This is quite an honor. I've been impressed with the community you've built in a really short amount of time, and it's focused around founders and entrepreneurs. And I work at a firm that was founded by entrepreneurs. We're not a bunch of ex-consultants sitting here working with founders. So knowing that experience is near and dear to my heart. And so it's exciting to be able to connect with people this closely.
Awesome. So why don't we start by giving us your backstory? I see there's at least one person here from Austin. Our community is all over globally, but a lot, I think about 60,000 in the US, 30
Nice.
or 40 in Canada, and it's fairly global. So you'll see people joining from all over here. I see Vancouver, I see
Exciting.
Austin. Cameron is asking, everyone's leaving San Francisco to Austin. What's happening? I don't know. It's cheaper, no state tax, Cameron. And people are super nice. Actually, Austin is the only city in North America that I've been to where people don't ask you, what do you do for a living?
Oh, they don't. Yeah, it's refreshing. I got into venture and startups by process of eliminating other careers that I realized weren't good fits. And one of my times was spent in DC, which is a city where you go and most of the first questions are, who's your dad and what did he do? It's not, or where did you go to college and like, who do you work for now? Whereas Austin, they're just excited to meet you.
That's what, and even when I come here alone and I walk around, people are so nice. You end up getting to know people and hang out with people you don't know. So that's amazing. So give us your backstory. How did you get into venture? You studied your MBA from the University of Texas. You did your BA in UCLA. You were in the Bay Area for a while, weren't you?
Yeah, so I grew up in the East Bay. And to be honest, I, for a long time growing up, wanted to be a spy, and not like the Jennifer Gardner alias, like the Zero Dark 30, very serious about terrorism and fighting terrorism. I was lucky to have parents who were like, sure, honey, that sounds like a great fit for you. They were both CPAs and, not very helpful as it was to getting into government agencies. So actually after college, I moved to DC and applied to every government agency I could while I was making pennies at a think tank. And in the process, I did get a job offer that was rescinded at the last minute due to a technicality. And that kind of like shocked me in the sense of, you're really in your early 20s, don't know what you want to do with your life. Think this one thing is what you want to do and that somehow you'll just succeed at it. And that was a good way for me to realize I don't like layers of people. I don't like bureaucracy, and I like to build things and get things done. So government is probably not a good place for me to start my career. So I moved to New York, and this is going to date me. I got a job at a startup that I found on Craigslist. So this is back when you used to post jobs on Craigslist and actually hire people. That was my first entry into startup land, was almost accidental. And it was a startup at the time that was building a marketplace for privately held shares of companies. So restricted stock, essentially. They later changed their name from Restricted Stock Market or Restricted Stock Partners to Second Market, sold to NASDAQ, and we're kind of off to the races. But I was there for a brief minute while I was applying to grad school, because my other realization was I needed some skills, and history undergrad and language specialization wasn't going to get me very far in the world of business. So I came to UT in Austin for grad school. Never thought I'd stay. But in the process, got really involved in both the venture community here when I started business school, and the startup community. A couple things happened. I met a guy, and he wasn't in my business school program. He actually was very much outside of the world of business school. He had started a company with his brother after graduating college. They were both collegiate athletes and felt, the ESPNs of the world aren't really giving their sports the coverage they deserve. So they were going to do something about it. So they started a company. And as we were dating, I was going through business school and learning supposedly how you manage people and how you build a corporate structure, And at the same time, I'm like talking to this guy I'm dating and asking him questions of like, so how do you manage your team? You guys work out of a house on the east side. Like, how does that work? Do meetings? And he's like, oh no, that's too corporate for us. So, it was just a good experience in kind of those seeing the early days of kind of the sausage being made. We're now married, have kids, and he has, 300 employees and is in meetings all day. So like, I think there's some level of corporate culture you need, but at that point, there was a reality of like, this is how you do it in the classroom. And then there's people who do it. And that was a really keen lesson for me in learning of kind of what it's like to build at that early stage. And so I had a couple really cool internships, worked for two guys who kind of just had a deck and a prototype at one point. And then I was lucky to land a job in venture after business school, which is rare. In Texas, there aren't a ton of funds. And I landed, luckily, a job at the biggest one that'd been around for the longest period of time, called Austin Ventures. And I kind of consider it my postdoc in venture capital and company building, because I worked for the team that did early stage venture and I just did deal flow. So bring as many deals in as you can, and got to see, the nature of the landscape in Texas at the time. And this is 10 years ago, and it's very different than it is today, but it's always been very different than the Valley. I think lots of people like to say things about Austin being the next Valley, and it's not. And there's wonderful things about it that it hopefully will never change. But the Valley's pretty special, and I think it's going to stay that way. So then after that, I actually got recruited out to go work at a startup, and I've spent, over half a decade working for founders here in Austin, either building out their business development functions or their corporate development functions, which had been something I love doing. I think, when you figure out kind of what your super strengths are, I'd have to say I like relationship building, and networking has kind of a negative connotation. I'd like to prefer relationship building. And so I've done that for, the last 10 years in Austin, and landed back in venture again due to relationships I built a long time ago, but also with the intention of working for a firm whose ethos was one that I understood and got behind. And our firm's tagline is for entrepreneurs by entrepreneurs. And it's something we hold our hat to, and kind of live by daily.
Awesome. That's a great background. And so much of what we do, I think everything we do is relationships, right? Life and business is a marathon, it's not a sprint, and relationships truly transcend companies. It's a key driver here. But that being said, the market is absolutely hot right now, right? It's bonkers. And hedge funds are getting into the venture game. There's a lot of people saying that I think VC is going to be in a tough spot with all these hedge funds sweeping in and just funding companies at high valuations at the early stage. There are companies that shouldn't be investing or traditionally didn't invest in early stage or in VC are getting into VC. Valuations are getting blown up out of proportion. How do you feel about all of this?
It's definitely different than when I joined the firm a year and a half ago. It's a new world, but I think VCs have adapted to changes over the years, and so have entrepreneurs, right? Market dynamics change and you adapt. And you decide what things you're going to hold the line on and what are important to you, and kind of fall back to core principles. So for us, I think we're a good sized fund in Austin, Texas. We're 130 million. It's our second fund. We're focused on Series A and B, and then we reserve 10% of our fund for seed. So we're at the earliest part of the company's growth. And to what you just said, yes, valuations are up, round sizes are up, and they're happening earlier than you would typically see based on kind of traction data points. So for us, we raised a fund before that world changed, and there's a healthy dynamic on our team of let's stay disciplined to looking for what we always look for, which is glass eating entrepreneurs, big markets, and in a space that's something we know about. So we're thematic investors. We've got 6 different investment themes that we focus on. So really like leaning into those and ensuring, that the founder is someone or founders, someone who eat glass, right? And if that's the case, the valuation at this point in time, is not going to mean much if they achieve what they say they will achieve. That being said, there is a certain point where a deal size does not fit our fund anymore. And so it will be past us. And that can be frustrating because you've spent a lot of time building a relationship. Seems like the perfect deal, but at some point we can't compete if you decide to raise 20 instead of 10. That's not what our fund's built for. So, it's an interesting dynamic. And I think the other thing, and I'd be curious to hear your take on this, is that most of our team has either lived through downturns in the economy or been at startups that fail or startups that overextend and end up raising down rounds or flat rounds. And so there is a healthy fear of, some of the funding that's going on is eventually going to catch up to founders and investors. And who's really hurt in that equation is not the investor. It's the founder who gets even more diluted and crushed often in those situations. So
why do you think founders are raising more money than they need to? Because it's interesting, right? Like, why do you need to get diluted? So for my background here, prior to Boast, I was a part of a few venture-backed companies. Last one, I was a part of 2 venture-backed companies where I was on the exec team, and everyone raised money like a transaction. Let's optimize for the valuation. And when you do that, the first time a major roadblock hits, things get shaky, and the second time another major roadblock hits, either they're out of there or you're out of there. They're not going to fund your next round. And so if you treat people like a transaction on the way in, that's how they're going to treat you. So I find this strange because then I was a part of another venture-backed company that failed, and Boast, we exclusively bootstrapped, and we raised money from friends that we had known. And it was just one investor. We didn't want many investors on the cap table. I just feel like having multiple people and huge expectations adds a lot of stress to the founder. I mean, it looks good today, the valuation, but if you can't grow into it, it's a problem, right? Like, so why do you think that is the case right now, where people are saying, oh, I'm going to go and raise 20?
Well, it's a good question. And I ask founders when, we have a good conversation and then we get to like, what are you raising, and kind of the nitty gritty, and they'll be like 15 million. And you're like, okay, why? Just honestly, why? And about 50% of the time I'm hearing, because some firm told me that's what I should raise, or one of my advisors said that's what I should raise. And then the other half, it's often very rationalized answers of like, we build a model, these are the milestones we want to achieve. And even I think the other thing is it depends on the space you're in. Like if you're in a highly competitive market and your competitors have all raised 20 million, to some degree, you need a war chest to compete with it. And we could argue that, like, does that mean the better company wins at the end of the day? And was that still a smart move optically, right? What signal does that send to the market if you only raise 5 and your competitor raises 20? So I find it kind of risky. And, my husband bootstrapped his company with his brother for nearly 5 years before raising money. And I think there's a lot of learnings in that. And often they take a little longer, I think, to learn, but your background in having done that is super valuable. Because you learn then you really only want to take money, to what you just said, from people you've built a relationship with. And that's hard to do in like 2 weeks of diligence.
Exactly. It's really hard. And when you got these sort of big giants funding or sort of hedge funds coming and funding large checks, how do you guys work? Like, you want to lead rounds? What is the ideal stage for Next Coast and location and all of that? That would be helpful.
So starting from the last bit, location, the two founders of our fund were very intentional with the name Next Coast Markets. Both had spent time in the Valley and moved to Austin, for all the reasons everyone's moving here now, but years ago. And then with the strong belief that there's huge opportunity to build successful companies in emerging tech hubs. So Next Coast Market is our name because cities like Austin, Houston, Dallas, Denver, Chicago, Salt Lake City, Raleigh, Durham, Miami, places where we have investments, are fantastic places to build a company. Talent is often cheaper. There's often a lack of capital at a certain stage. And so hopefully it's a stage that we play at, because then we can come in and be their provider. But in terms of stage, we are primarily focused at the Series A and B. And I say primarily because that's where 90% of our dollars go. And at those stages, we write lead checks, take board seats, and really do our best to help founders grow their company. As a team, we're ex-operators, so company building is something we think we're strong at and we can be helpful on. At the seed, we are active, but we come in behind a lead seed fund. And so we'll write a smaller check, often around the size of $300K to $500K, which depending on what you're raising can be impactful. And then we'll be often kind of like your second line of defense. So we'll take board observer role. We'll do quarterly meetings. We'll get to know founders and the technology they're building in their industry, if it's new to us, better. So that as you grow, we're both in a better position to decide, is this something that makes sense for us to write a bigger check in, and do you want to work closely with us, right? And that's only 10% of our fund. So the majority of our time is really spent on Series A and B.
This is a good segue into my next set of questions here, right? Before you raise even $1 of funding, it's important you have an idea, you have product market fit, or at least some validation. How should startups think about building products as they go from idea to product market fit and potentially hypergrowth?
Yeah, it's a great question. I mean, I think that the funny thing that you see in the market and that makes headlines right now is founder XYZ literally raises 10 million to 20 million on a deck and a dream, right? And they've done it 5 times, so people want to give them money to do that. But that's not the reality that most founders face, and the reality that they have to live, right, to raise money. So I think there's a fine balance between building a good enough product to what you just said, to prove, to get to proof points. And those can be a range of things. Many like to think revenue is the best proof point, right? Like that someone gave you dollars, gave up money to use your product. I think there are other proof points that matter too at the early stage, right? Because someone can give you money once, but are they going to give you it again? And are they actually going to use the product, right? So there's not necessarily like one metric we look at, and I can't speak to other funds, but a concept of customer delight and happiness. And that it's working, right? It can be duct tape on the back end, but to the customer, the experience is valuable.
Definitely. Has the dynamic sort of changed in this day and age? Like, what do you see as being a seed round? Do you even recommend people raise money to validate an idea? What metrics require an A? What metrics warrant a B? What are your thoughts there?
That's a great question, because what's happening in the market is different than what would happen a year and a half ago. Pre-COVID, everyone would like to think, at least in the areas we invest, right, sort of out of Silicon Valley, to raise an A, you should be at $1 million in ARR, right, if you're a SaaS business. That's not the case today. Companies are raising far earlier or on different metrics. Again, it kind of goes back to, for us, the transition from seed to A is that you can prove product market fit, that you've established some level of that. And then really A to the B is often you've figured out 1 to 2 to 3 go-to-market strategies that actually work, right? You raise that A round to go test a bunch of go-to-market strategies. You figured out a few that are great, and let's go raise a B to just pour a bunch of cash on those. That's kind of like the old world of thinking and what we try to stay disciplined with. How you measure those really depends on the company and the industry.
Are you a proponent of raising a seed round when you have an idea, or not quite?
It's a great question. So we did, I joined a year and a half ago and was managing our seed investing for the beginning. And we did 20 deals in the span of like 18 months at the seed stage. And almost a third of those were to pre-launch companies. So we had no data points on like tangible sales sort of data points, user metrics to say it was working. And so on those, you know, we got comfortable because it's often the founder in a market we know, or a founder in a big enough market that they can make some mistakes, but still tackle and solve a big problem. I think it's really hard to go raise a seed round if you're a first-time founder and you have no proof points. So to the first-time founders who are trying to do this for the first time, obviously, I would try to do as much as you can to prove that there is product market fit, any signs of it, or there's a great market for it, an appetite before you try to go raise money. Because every time you do that and you prove one of these things, you de-risk the deal. And so instead of raising 2 million at, you know, a 10 million pre, you can raise 5 out of 15 million pre, or whatever the case is, but you've de-risked the deal and you maintain more of your ownership.
Definitely. And money is a means to an end. It's not the end in itself, right? And people don't realize that. They raise money. I view everything as sort of dating. You don't go to a bar and ask somebody to marry you the first time you see them. It's like, okay, what are the phases of a company? And I was looking back through the failed startups I'd been a part of, and it was like, okay, phase 1 is validate the market and get validation in whatever means possible. Phase 2 is get to product market fit, and you know, maybe the channel doesn't matter as much as long as you've high retention. Phase 3 is okay, let's figure out one scalable channel and make sure that we have that channel market fit, and then you know, you scale where you spend 2/3 of your time sort of scaling what you've nailed, and a third trying to figure out new things. And Boast is at the scale phase. But I've seen some very interesting ways where people have validated markets. One friend of mine, he's the founder of this company called Lumen 5. It's like Canva for video. They've got 800,000 users right now. And in the early days, he would just put video gigs on Fiverr to validate. And he's like, I got 100 gigs. And I did them all manually, but I figured out what I needed, what automations I needed to build so people can self-serve it. And that's kind of what we did with Boast. We ran it as a consulting shop, got a lot of manual customers, and then started building product. But people always gravitate towards, oh, I should raise a seed round. And then 18 months, I need to raise a Series A. And then 24 months later, I need to raise a B round, et cetera, et cetera. It doesn't always play out that way, right? But yeah, so as you think about those phases from like validation to product market fit, and you've been in the BD space for a long time before your VC became a VC, what should and shouldn't founders prioritize to growth? How do you think about it?
Yeah, that's a great question. I mean, I think it's a chaotic time, and it's a time of highs and lows, right? Where you can't just build it and hope they'll come. And I think plenty of books have been written and people know that now, but you still see that from time to time of like, we invested all this in a product and like no one's showing up after we start running ads for it. So often it's not black and white. I think you can start building. At the same time, you start testing market interest. And there's hundreds of ways to do this and growth hacks to do this. And I'm by no means a growth hacker. One we see a lot, I see founders using is I'll create a wait list, right? I'll run, you know, $1,000 of ads, see who I can get to a landing page and see if people will sign up to learn about it or to get access to it later. You know, and some are like, you know, some of them, the goal is like, I'm going to have a wait list of 100,000 people and then we'll raise our A. And so like you can get obsessed with these sort of metrics and proof points, but I think you need multiple validations from the market. Like that's a great one. I think talking to industry experts is a great one. Talking to whoever it is in the world where you're solving a problem matters, and getting their take on either the problem or your solution, and incorporating it before it's live to any extent. Some people get obsessed with running betas, right? We're going to have an alpha, and then we're going to have a beta, and then it's going to be X release and Y release, and eventually you can sign up for it online. So there are a million ways to do it, but I think the more ways you can test and validate from just a wait list to actually a beta gives more power to you as the founder.
Yeah, and there's more and more other ways to fund your businesses. I think one great way is customer revenue. The other great way right now is equity crowdfunding has become a thing. They've increased the limits on it to 5 million, I believe. And there's a lot you can do there by way of equity crowdfunding. There's I think nothing beats customer revenue. There's WeFunder. We recently did a webinar with them where people are raising small amounts of money. How do you think people should go about funding that first round? Like, have you seen one ideal way, or there's no ideal way?
There's no ideal way. I mean, I think the tried and true way for years has been like friends and family, right? And some combination of customer funding, but not everyone has friends and family that they can call on to give them checks, obviously. And so I think that's actually a really interesting challenge for founders who don't have that background, and a great opportunity to do what you described earlier, which is start building relationships. And this was one thing I failed to mention for your last question of what you should prioritize. There isn't necessarily a too early time to talk to an investor. It just depends on what you want to get out of the conversation, right? So if you're approaching talking to investors, if I have an ask and it's $2 million and this is what we're building, and when can you start your diligence? Like, that's not how to start any of these relationships. And I'm sure your relationship with your investors did not evolve that way. I think that, hey, can I pick your brain over coffee? You've invested in XY companies. We're in a similar space. Love to understand how you think of it as an investor and share with you what we're thinking about building is like an excellent intro and a great point to start. And then to keep that person updated. So I think relationship building should always start at the beginning, and the relationships can be investors, advisors, which is, I know something we're going to talk about later, industry experts, thought leaders. A lot of founders want to have all the answers and have a product to show and all these things. And it's not that black and white. It just depends on scaling back your ask from the other person and what you're giving in return in that interaction. And that can slowly build to something greater over time.
Definitely. And with what I found from that experience that I've been a part of was that whole, it creates a crap dynamic when you optimize for valuation and numbers, because ultimately all founders have to be salespeople. And if you exaggerate too far to the left, then the second board meeting honeymoon is over, right? And it becomes a very, very tough conversation. And so I would say, when you're bringing on an investor, you're bringing on a partner, and it's really, really important to be honest going in. If you don't have the numbers, then just come back to it, right? Like, we just punted a raise. We had a lot of interest for a B round, something like 20 plus investors, and the market's really hot. The space is heating up. We're a community-led company, and 2 weeks ago, we emailed everyone saying, "Hey guys, we're gonna take a little more time. I don't think the time is right. Yeah. We have all these new execs who've started in the company in the last 2 months. Yes, they come from building multi-billion-dollar companies, but I don't want the team, a company that's gone from 30 to 100 people in 6 months, I don't want the team feeling like they have to run with a gun to their head, right? Yeah. So let's see how things play out and regroup in January, February next year, kind of thing." But maybe many other people would have just persevered and tried to raise the money. It's like, you don't need the money, you don't need the dilution, just take enough to, and I shouldn't say like treat your startup as an experiment. I think just enough to prove the next point, right? You look at a lot of companies. You guys are primarily investing outside of Silicon Valley. Does international count? Does Canada count?
Great question. I saw that in the chat. We don't invest outside of the US. We, in theory, could. It's not a mandate. It's just, we have no networks outside of the US. And if we are going to invest in a company and ideally, help with resources, whether that's hiring or advisors and whatnot, most of our network would not be in the areas you're building your company. That being said, we have a fantastic portfolio company called InBorder, and they moved from Australia to Austin. The founder is here now, and they're growing their team here. And I don't know the exact timing of the check, but it was a move in process when we made that investment. So we've done things that have moved to our markets, but we haven't gotten.
What's really funny is many venture-backed companies or startups outside Silicon Valley, outside the US, thinking about raising venture, end up registering a Delaware C. And right now, in the post-COVID era, there are no walls, right? So it's really funny. I live in San Francisco. My co-founder's in Vancouver. Our company, 60 out of the 100 people or 70 out of the 100 people are in Canada. But all the key execs are here. So we're now starting to leverage the globe for economies of scale here and talent when you don't have walls. Otherwise, if you're in Silicon Valley, you're always fighting for talent. And it becomes extremely, extremely hard. So in all the companies you've invested in, what are the key signs of a great market potential, great go-to-market? What are some telltale signs and channels that you've seen?
Yeah, I think I'd start with where we always start, which is founder, right? So there's founder market fit. And depending on the founder's background, and if they've done it 10 times, you can kind of get comfortable with them deciding to start in another market. But for us, seeing that they really understand their market, they may not have spent 10 years in it in a decade and know it in and out, but their passion for it and their ability to educate us on it is kind of how you can see back. They really understand the problem they're trying to solve, and they're willing to run through walls to do it, so that's kind of one. And typically that same sort of passion and excitement helps them build teams, right? The biggest thing, and you've had to build a team, is can you recruit people? And not everyone has that skill. Can you get someone else to jump off a cliff with you and build this company and take a massive risk? That's another thing we like to be able to see, right? Can they add talent? Have they done it in the past? And so can they do it again? As it relates to market and signs of traction, we all like big markets, right? Everyone likes to talk about a massive TAM. And there are different ways to skin that cat, and you can come up with, the founder can come up with one way and we can come up with a way and we can argue about it. But, I don't think we get too wrapped up about that if we can at least see line of sight into bigger TAMs. So if, let's say, the market you're targeting is 500 million today, but it can grow into $1 billion, or you're going to launch in a lateral industry or whatever it is, and suddenly we're at $1 billion. That's much easier for us to get comfortable with, because you always have to think of the size of the fund and the outcome they want as you're talking to investors. And it's not the outcome they want, it's kind of the outcome they need to return their money to their investors. So if it's a small seed fund of less than 50 million, $150 million exit might be awesome for them. They return, half or all their fund if they got good ownership, right? But for a fund that's bigger, they need to see an opportunity to sell for more, or IPO for more, whatever it is. And so, that's the other kind of thing we look at. And then we try to invest in things that we either know something about or can be helpful with, right? Otherwise, that's why we're not in medical devices or pharma. We don't know anything about that, and we'd be terrible partners.
Definitely. So let's flip it the other way around, right? What are the type of investors that founders should look to work with?
Yeah, I really liked that question. I think you need to kind of do some level of self-assessment as a founder and figure out, do I really understand my industry or not? Could I use help in that space, whether it's introductions to either customers or partners? is that something we're not strong on? Or this is my first time, I'd really like an investor who can help me build a sales team and coach me on hiring a COO or a CTO. And so you kind of have to self-assess, like, what are my greatest needs? Is it strategy, right? Should we find an investor who's really great at big thinking and taking it to the next level, whatever that is? We end up in the company building bucket. Like, as a team, that's what we're good at and what we bring to the table. We can do the introductions and networking as well, but like, that's kind of our core secret sauce as a firm. So I think as a founder, if you think about what it is you need, you can figure out what firms are good at. And you can learn about that in any number of ways. Start on their website, look at their LinkedIn, the obvious stuff that I'm sure most founders do, but then you can talk to other people who've raised money from them. Again, I think having a network of fellow founders, which you don't always think about when you're just going through it, right? You're just trying to get to the next day and the next week and the next sale. And you're not always getting support from your peers. And there's one thing I've seen my husband like suffer through in some ways, like he had no peer support for a long time to tell him, hey, that's totally normal. Have you thought about it in this way? Or, switching that title to like very granular support that I think other founders can offer at an emotional and tactical level. They can also tell you, no, that investor's not going to be a fit. They invested in a competitor, or they only care about Y and you're focused on X. So you can learn a lot by talking to a lot of people. And again, it goes back to the network you're building, which is hard to do when you're growing a company, is to make time to build a network.
Definitely. And there's a few questions there that I want to see if relevant. But the one thing I want to touch on is founders shouldn't feel powerless in the fundraise equation. There's this TechCrunch or the media has created this power imbalance where VCs are glorified, and not to say that you shouldn't be, but I'm coming at it from the founder perspective, and founders should always be subservient by glorifying raises, VCs, funds. And I think it's a partnership. And if you think about it, if you think that this person is on a pedestal, you're already starting from a wrong point of a partnership, right? And then you start making up stuff, you start exaggerating stuff, you're not honest, and you can't go, like, you don't get married exaggerating to the nines, and then like after the wedding night, you find, I have a marriage analogy for everything.
Oh yeah, marriage is a great analogy.
Right, and then they find out, they're like, oh, you know what? You're wearing a wig all this time, kind of thing. So those things are important. You got to treat it like a partnership. And one of the key ways to think about a partnership is you do back channel references and having a great network of founders. And that's what we did. Although we knew our investors at Radiant from our community, we talked to a lot of people that they had funded. We just knew from Slack groups and everything else. And that was very, very fruitful for us. So, but the thing is, if you're desperate for money and you raise when you absolutely need the money, then you don't have those choices, right?
No.
You got to balance it in your favor and focus on the metrics here. A question here in favor of the equity crowdfunding, and maybe I opened a can of worms by bringing that up. But how do you feel when a promising startup already has a cap table filled with many people from a crowdfunding round? And I don't think it needs to be that way. That's more a legal question, but.
That's more of a legal question. I defer to our COO on that. I mean, if it's someone we want to fund, like we want to put a term sheet into them. Cleaning up a cap table is not always fun. And so I'm not familiar with how those crowdfundings are structured and their rights, depending on the round they come in. What we have seen a lot of recently, and this is, I don't know if it's a new phenomenon, it feels new, but a lot of founders raising, not quite a rolling raise, more like every 6 months, they open up a safe for $1 to $2 million at a slightly higher cap and get money in that way. And then when they go out to raise a big round or a bigger round, like a price round, no one's done the math for them on like the pro forma of what that converts into. And so those cap tables can be messy because they're sort of like invisible cap tables that if you're in Carta, like your convertible securities don't show up on the front page. And so you don't actually have a great sense of the equity you've theoretically given up. And so if you have a really good lawyer and someone else, an advisor to help you, I would create a pro forma at various valuations of everything that converts, because it can quickly show you like, oh, I thought I was only diluting myself 15%, and now I've really lost 30% because all those caps, were lower and lower and lower, or we didn't, there's a lot of different math that goes in there, but that's something that I think we've seen several times where founders do this practice of sort of constantly raising, and they're great reasons to do it. And then they raise a price round and they're like, oh, like, I didn't realize, like, I already gave up 20% of my company, 30% of my company. And if you have co-founders, like, you can easily do the math on what that really looks like for you. So I'm less, sorry, I didn't answer your question because I'm less familiar with crowdfunding.
What I've seen though is, like, in those cases, if they're smart, they do like a special purpose vehicle and have everyone pull into that and then invest as one entity. So you're not cleaning a crazy cap table, but I'm not over too familiar as well. So let's, I want to close the book on the fundraising here with, what are the key metrics these days for each stage of the race? So pre-seed, seed, A, B. What are some common metrics you're seeing?
Yeah,
or like
I laugh because I think
you will get behind, maybe.
That I will get behind. I like an intangible metric that you can find other metrics that lead into, which is sort of some level of customer happiness, right? That you are delivering value, solving a problem, and people aren't fleeing as fast as they're coming, right? Like, leaky buckets exist, right? And so whether that's a combination of top line growth, low churn, and high customer satisfaction, there's millions of ways you can measure those today, and everyone's different per industry. But it's not tangible, but really customer happiness. And I can go measure that as a VC by talking to your customers as well, or trying the product out, or getting, a couple experts in our network to take a spin. There's really not one metric anymore, right? Like, this idea of $1 million in SaaS for SaaS companies and ARR is not what's happening in the market at the Series A, which is really where I've spent a lot of my time. So unfortunately, I don't have a great metric for you, but to go back to your comments before, and you said it way better than I did, the seed stage is proving, it's all about going from seed to A, is proving product market fit. And there's a million ways to measure that. And then A, in our mind, similar to yours, is like, let's figure out a good go-to-market and test a bunch of strategies. And B is let's scale and pour gas on the fire. And that's something we tend to stick with, right? And you can measure it different ways.
Yeah, and then you did bring up that, typically $1 million, we've seen A's at these days lower, and then I think at B 5, was it, or less?
Probably it was 5, and now it's like 2.
Wow. So if you had to pick, what is most important, growth rates, retention, gross margin, or a combination?
You can't pick one. It is a combination, right? It's like a combination of why we invest in anyone, right? It's not just the founder or the market or the product or, the whatever it is. It's unfortunately kind of this scale that, you put the founder over here, but oh crap, the competition's really heavy. But then you add their team and you add what they're building, and it's the next generation, and like skill, it starts tilting, right? And it goes back to relationships, right? Like you said it, most investor relationships, ones like ours that you would do, last longer than the average marriage. So spend some time getting to both sides, spend some time getting to know each other, because I think that first board meeting or second board meeting, to your point, if things go wrong, like, you will see the other side of the person and how they handle it. And you're kind of stuck with them. It's really hard to get rid of an investor.
Definitely. So let's go into the key themes, because at Next Coast, you guys have some great themes here.
Yeah.
So maybe walk us through that. Software 3.0. We'll talk about community-led, retail, retold. You have a number of different themes.
Yes.
What does software 3.0 mean to us or to you guys? And what are some good companies you're seeing in that space?
So great. Let me first explain how we think of it, thematic investing, because I think other firms talk in the world of theses, and some are thematic. I think Founders Fund out of Colorado was like the one to put it out there and put their investment themes on their website, and they've done a really clever job of it. And their investment themes, like, it's kind of 2 words. So there's a lot there's a blog post every now and then, but like there's a lot for you as a founder to like read into. We've put a little more content behind ours, but they're by no means monolithic. So they are evolving as the market evolves, and it's more of how we're thinking of a certain space. So software 3.0 was actually 2.0 for a while in Fund 1. And at that point, we were very interested in vertical SaaS. There was a thesis that software is eating the world. Mark Andreessen kind of ate the world, right? Software is everywhere now. So we've moved from focusing on vertical SaaS because some of those investments we saw sort of tap out at a much earlier point than we expected. And so the latest way we've been thinking about software and companies that build software and sell it, the keys to success often come around how obsessed with the end user are they? You can call it product-led growth, you can call it any number of things, a bottoms-up approach, but really it does matter now at the end of the day what the end user's experience is. Even if they're not the person buying the product, you really should build for that experience. Because the competition on how you go to market is higher than it's ever been in software. So that's SaaS 3.0. And obviously we pay attention to kind of emerging technologies, and they're not emerging at this point, they're here, AI, machine learning, and whatnot. Our other 5 themes, just to hit them off really quickly, is the future of work. And we're not original in that. That's been in a focus of many people for many years now, and how it's evolving. So we've invested in robotics companies, we've invested in gig economy companies, we've invested in companies that are the infrastructure to run a gig economy platform, many iterations off of that. One big announcement today, a company we invested, we were a little investment in their early round, just raised $200 million from Norwest, called Icon, and they are reinventing the world of construction and how construction workers work. They print homes, 3D printing via concrete. So there's many ways it can manifest itself in terms of an investment. It's more of this is a trend, and there are subsequent technologies that will support it. So our other investment themes, consumerization of healthcare, which we call it self-care hacking, because we kind of stop as a firm at the edge of the patient, right? So we know we're smart as it relates to a patient, the patient acting as a consumer. We typically don't invest in provider, so doctor solutions. And that's our third theme. And then we have marketplaces as a business model. So over the years, we've invested in numerous marketplaces in different industries, and really understand the efficiencies that a marketplace can bring to an inefficient market. And then the next 2, one is around the future of retail. So that's vertical specific. And I think, the first iteration of that in our first fund was direct to consumer companies. And we've made numerous bets in that, and some have really played out well. And then we've learned a bunch. And at the same time, I think what we've seen for Fund 2 and what we focus on for Fund 2 is it's not a retail apocalypse. The world of brick and mortar does continue to persist, and it's going to persist in often a slightly different modified customer experience. And at the same time, the values of consumers and the younger generation are changing. And so what companies are going to support this changing dynamic in the market as the next generation has more and more wealth to buy products? What values do they bring? And then the last one, which is our newest, but it's been something we've kind of been investing in for a long time, is online communities, not social networks. So, you have your big walled gardens of Twitter and Facebook. And I think a lot of people in COVID has just sort of accelerated this, seeing diminishing returns often through some of their relationships on those networks. Like you don't log in and have the same satisfaction that you might have before. And we're seeing now a much stronger interest from consumers and people in the business world to want to belong to a tighter knit community, and they're willing to pay for it, and they want some level of exclusivity and personalization. And so that can be a whole business we invest in. It can be software that supports a community that's built that way. And it often can be, these themes are not, you can be in multiple themes. So your company is community driven. That fits our thesis there too. So I don't know if I explained myself well. I'm sure there's going to be plenty of questions, but the community one has been one that's super fun for me personally, because the company that my husband and his brother started was really around passion-driven sports, right? Like there are these communities of people who love track and field, wrestling, band, cheerleading, whatever it is. And there is no place, or there hasn't been a great place for them all to go for a long time. So I got to see early on, how you build infrastructure to support that, and what do you pull in that keeps people really involved.
Definitely. And I'm a big fan in community-led as well. Boast is a community-led company. It's funny, when we started, we used to do these pizza nights, and every time more and more people would show up, that turned into a conference, that turned into now 120 webinars a year in a community. Yeah. We do dinners in different cities. And it's funny, it's all cost neutral. We donate the profits. And what we found is that everyone from our biggest customers and many of our customers to key execs and our investors all came from the community. And what's really interesting is we hired, like, our CTO comes from Avalara, 13 billion market cap sales tax software. Our CMOs come from 4 exits, 1 IPO. Our independent board member was an SVP at Intuit, most recently sold a company for $1 billion. We met all of them through this community network.
That's pretty awesome.
We did not use a recruiter. So that is the value of community, is that when you're either in a new market or a fragmented market where like everyone is in there, the brand you get from building community is irreplaceable, and it becomes a moat in and itself, because they're like, hey, you know what? I go to this conference or I join these webinars, and these guys hang out with such awesome people. They're providing so much value. And so the fundamental philosophy was fall in love with your customer and make them successful beyond your product or service. If you build a community, you won't become a commodity. So I love the community.
That's awesome.
Mindset. When you say community style companies, and your husband's company is a great example, it's a good go-to-market channel. What other companies have you seen that have done community well?
Yeah, great question. We've got, some in the earliest stage right now. So there's one out of Montana that we actually invested in, that's building a platform for creators who are often disenfranchised from large platforms like a YouTube, or independent film creators or content creators can go and actually monetize content. So Patreon, you can go to and you get donations, but you can't put your content very easily behind a paywall and then it to be exposed to subscribers beautifully. So that's one that's in really its early days. I think, one thing you said that there's a word that I think is slightly missing, which is authenticity. And you guys built a truly authentic community that then led to people joining you. And that's hard to do. It's one thing we as a firm aspire to do. And pre-COVID, we used to host what we called meetups, because we invested in a company that was like a direct consumer meat company. And so they'd barbecue a bunch of meat, and we'd take out our parking lot and get a bunch of kegs and just invite the local startup founder community, obviously our portfolio companies, but just people who we don't get to see often. And genuinely get to know other and new people better. So I think the world of community too has changed with COVID to a degree, and people are shifting to more to find it online than they were actually in the past. And so, we've seen recently, I've seen a lot of different more like infrastructure plays on how to support communities. There's one that hasn't been announced. It's building, it's community driven in the sense that they support independent creators, but they're doing it from a let me help you with your finances perspective, which if you're a 1099 is very complex. And so, there's different ways it can take form for us, but I think the main thing that I look for, and then it sounds like you found with your community, is truly like you have to build authenticity, right? With them.
If you're not, I mean, ultimately relationships trump everything for me. And I feel like, yes, webinars and online events are great. And I feel like anytime you add more than 2 senses, we're now sight and sound. But once you start incorporating taste, touch, smell, you start building genuine connections. And that's why we do a lot of in-person events. And I'm just bummed that we can't do it right now. But on the contrary, we added 50,000 subscribers in the last year just from doing virtual, because I guess there's the FOMO and everything else. But these are some great themes here. Questions around basically, how do we get in touch with you? Is cold emailing investors such a thing? Because everyone asks to submit online.
Yeah.
What is the best way, kind of?
I mean, we have an online form on our website. We haven't invested in anything that's come through it. We look at them, but we haven't.
Why is that? So that's a very important question. That's what people are asking, right? How should startups think?
The quality honestly is low, or they're just like out of like left field. Like it'll be out of something we invest in. And so honestly, it's like we don't invest in medical devices or flying taxis. Like that's not something we're smart and can be helpful around. I spent a lot of my life cold emailing people. So
you came from the BD world.
Yes. I try to respond and have huge respect for people who do it. I have greater respect for people who spend time and like think about it. I mean, I get a fair share of Mr. Floreani emails. And so like, if you can't figure out, who I am, I'd hold that email off, because a bad cold outreach is worse than is like double worse than a so-so one. So I try to respond to those as I can and quickly as I can, especially if they're fits or not fits. But introductions, to the point, also show that you can build relationships with other people. And that's key to building a company. You got to hire people, you have to grow a team, you have to get along with your team. And so if you can do that in the community, that often reflects on what you can do in your business. And they're actually not as hard to get as people think. I'm sure, having been in PD, I figured out clever ways to ask people for introductions. So, I think just thinking a little harder before you write that generic cold email can really put you a little higher in the inbox for most investors.
Yeah, exactly. And people don't realize that this whole process, right? It's like dating. It takes a long time.
Like
you optimize for the number, not for the marriage, and then you optimize for the text back and the conversations and whatnot. Like we were not raising when we started talking to people, and we've continuously built a relationship and brought them along the way, and that is more important. And making connections, getting to know each other, inviting them to your events, all of that. And if you treat it like a transaction and start bombarding people, it may not always work out. So that's what I think. The intros help a lot, especially from a founder that you may have funded. So I would tell people like, hey, research them, look at the thesis they're investing in, look at common people, maybe a portfolio somebody can make the intro. So this is great.
And one last thing, I think, taking a no and then never going back to that investor who maybe you built a good relationship with, or you did feel something clicked, you're missing an opportunity, because it changes every day when you're building a company. And often, 6 months from when you first talked to them and they may have said no to where you are today, it could be a different conversation. So keeping that relationship alive, if you did feel there was like a very good, trustworthy, authentic connection, can help you with not just funding, but like if you're hiring a CFO, everyone is kind of like 1 to 2 people removed from another. So you never know when you might need to contact them again, and keeping it warm and ending it on a great note is something we try to do, right, too. Because we're very aware of, you might pivot and change sales strategies and boom, all of a sudden it's up and to the right. And we'd love to talk to you again if we know that's happening.
Exactly. This is awesome. A bunch of people asking for recordings. Just go to boast.ai/blog and you'll see under resources all the past recordings. Usually within like maybe a week, we'll have them posted. So Zaz, this has been a great conversation. It's just, I think, flowed very naturally.
Yes,
Thank
and
you.
I'll put my email in the chat. I'm happy to meet people, especially from this community.
Awesome.
Thank you so much.
Yeah, definitely. Any sort of podcasts or books do you recommend for people? I don't know, you're in BD. Like, what do you recommend? What do you see the founders have gaps in that you recommend they get spruced up on?
I mean, I'm old school in some of my relationship books. Like I felt like when I listened to Dale Carnegie on a road trip with my husband, and both of us were like mind blown. Like, for some reason we missed this book in our early days, and it was just like taking people to lunch is such a simple concept and taking an honest interest in them. But recent stuff that I've been listening to or reading, there's a woman named Deb Liu who's got a newsletter, and it's a free Substack, that it just has great nuggets, like less than 5 minutes to read on management, that I find valuable in my job right now. Like one was on how to manage presentations, and others like how to ask for things. So Deb Liu, and it's from Perspectives. And then the podcast that I just find fascinating because they cover such interesting things is one called Acquired, and they have like a one you can pay for that's super valuable as well, where they'll do extra interviews and things like that. But they typically cover like the real story of a founding company and how it got sold, which is just fascinating because they're good at making the shine that like the tech news likes to put on things and kind of like pulling some of that back, which has been great.
Yeah, definitely. And Dale Carnegie, I can't speak highly enough, right? I one of the first books I read was How to Win Friends and Influence People. How to Win Friends and Influence People by Dale Carnegie. And there's another book called Influence by Robert Cialdini. A lot of principles from Dale Carnegie time 20, 30 years ago apply today and forever. And they always will, because those are like sort of first principles of relationship building. Zaz, thank you so much. We should have done this in person. I completely forgot I was going to be in Austin.
You could have come to our office.
Yeah, definitely. This was great fun, and look forward to catching up live in Austin the next time I'm here.
Yes.
Have a great one. Lloyd. Love and peace. Bye. Yeah.